Investing is an essential part of growing wealth and securing financial stability. There are various types of investments available in the market, and choosing the right one can be a daunting task. Now, we will explore the different types of investments, including stocks, mutual funds, exchange-traded funds, ETFs, bonds, options, cryptocurrencies, and real estate, and their characteristics. Additionally, we will also evaluate the risks, returns, and potential profitability of each investment type. Stocks or equities represent ownership in a company, giving investors a share in its profits and losses. They are bought and sold on stock exchanges, and their value fluctuates depending on the performance of the company and the overall market conditions. Investors can make money from stocks in two ways: capital gains or dividends. Capital gains refer to the appreciation in the stock's price over time, while dividends are a portion of the company's profits distributed to shareholders. Examples of stocks include Apple Incorporated, AAPL, Amazon.com Incorporated, AMZN, and Microsoft Corporation, MSFT. The risk: stocks are generally considered a high-risk investment due to their volatility and susceptibility to market fluctuations. The stock market can experience sharp declines or even crashes, leading to significant losses for investors. Returns: the returns on stocks are generally higher than other types of investments, with an average return of around 10% per year over the long term. Bonds are a type of fixed income security that represents a loan made by an investor to a borrower, typically a corporation or government entity. In exchange for the loan, the borrower pays the investor interest over a specified period, after which the investor's principal is returned. Bonds are generally considered a less risky investment than stocks, as they offer a fixed income stream and have a lower risk of loss of principal. Examples of bonds include U.S. Treasury bonds, corporate bonds, and municipal bonds. The risk: while bonds are generally considered less risky than stocks, they still carry some risk. If the issuer of the bond defaults, the investor could lose their principal. Returns: the returns on bonds are generally lower than stocks, with an average return of around 5% per year over the long term. Real estate investments involve buying, owning, and managing properties for the purpose of generating income or appreciation. Real estate investments can take various forms, including residential and commercial properties, rental properties, and real estate investment trusts, REITs. Examples of real estate investments include buying and renting out a residential property, investing in a commercial property through a limited partnership, or investing in a REIT that owns a portfolio of properties. Risk: real estate investments can be subject to a variety of risks, including changes in the local real estate market, unexpected expenses, and tenant turnover. Returns: the returns on real estate investments can vary widely depending on the type of investment and location. According to the National Association of Realtors, the average annual return on real estate investments is around 8% to 10%. Cryptocurrencies are digital assets that use encryption techniques to secure and verify transactions and control the creation of new units. They are decentralized, meaning they are not controlled by a central authority, and can be bought and sold on cryptocurrency exchanges. Examples of cryptocurrencies include Bitcoin, Ethereum, and Ripple, XRP. Risk: cryptocurrencies are highly volatile and subject to significant price swings. They are also susceptible to fraud, hacking, and regulatory changes. Returns: on cryptocurrencies, the returns can be substantial, with some investors seeing gains of over 1,000% in a single year. However, they can also experience significant losses. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. The funds are managed by professional fund managers who make investment decisions on behalf of the investors, and the returns are distributed among the investors based on their share of the fund. Examples of mutual funds include Vanguard 500 Index Fund, FINX, Fidelity Contra Fund, FCNTX, and American Funds Growth Fund of America, AGTHX. Risk: mutual funds are subject to market risk, and their performance can fluctuate depending on the performance of the underlying assets. They are also subject to management risk, as the fund's performance depends on the skills and decisions of the fund manager. Returns: on mutual funds, the returns can vary widely depending on the fund's asset allocation and investment strategy. The average annual return on mutual funds is around 6% to 8%. ETFs are similar to mutual funds, but they are traded on stock exchanges like stocks. They are designed to track the performance of a particular index or asset class and provide investors with a low-cost way to gain exposure to a diversified portfolio of assets. Examples of ETFs include SPDR S&P 500 ETF, SPY, iShares Core US Aggregate Bond ETF, AGG, and Invesco QQQ ETF. Risk ETFs are subject to market risk, and their performance can fluctuate depending on the performance of the underlying assets. They are also subject to tracking error risk, which occurs when the ETF's performance does not perfectly match the performance of the underlying index or asset class. Returns on ETFs. The returns can vary widely depending on the ETF's asset allocation and investment strategy. The average annual return on ETFs is around 6% to 8%. Options are contracts that give investors the right to buy or sell an underlying asset at a predetermined price and time. They are commonly used for hedging or speculative purposes and can be used to generate income or protect against losses. Examples of options include call options, which give investors the right to buy an underlying asset, and put options, which give investors the right to sell an underlying asset. Risk options are highly complex and can be extremely risky, as their value is derived from the underlying asset's price. They can also be subject to expiration risk, as options contracts have a finite lifespan. The returns on options can vary widely depending on the option's strike price, expiration date, and volatility of the underlying asset. Commodities are physical goods that are traded on commodity exchanges such as gold, silver, oil, and agricultural products. They are often used for hedging or speculative purposes and can provide diversification benefits to a portfolio. Examples of commodity investments include purchasing gold bullion or investing in commodity futures contracts. Risk commodities can be subject to significant price fluctuations due to supply and demand factors, geopolitical risks, and market speculation. Returns on commodities. The returns can vary widely depending on the commodity's price movements and the investor's investment strategy. Let's now see the riskiest and safest investment types. When it comes to risk, cryptocurrencies and options are considered the riskiest investments due to their high volatility and complex nature. While they can generate substantial returns, they are also highly susceptible to losses. On the other hand, bonds and real estate are generally considered the safest investments due to their fixed income streams and lower risk of loss of principal. However, the returns on these investments are also generally lower than riskier investments such as stocks and cryptocurrencies. In other hands, the most profitable investment types are. When it comes to profitability, stocks and cryptocurrencies have historically provided the highest returns. Over the long term, stocks have provided an average annual return of around 10% to 12%, while cryptocurrencies have seen tremendous growth over the past decade, with some cryptocurrencies such as Bitcoin providing returns of over 1,000% in a single year. However, it's important to note that past performance is not indicative of future results, and investing solely based on historical returns can be risky. It's important for investors to consider their investment goals, risk tolerance, and investment time horizon when selecting investments. As we see, each investment type has its own unique characteristics, risks, and potential rewards, and investors should carefully consider their investment goals, risk tolerance, and investment time horizon before making any investment decisions. Diversification is key when it comes to investing, and investors should consider building a well-diversified portfolio that includes a mix of different investment types. This can help to reduce overall portfolio risk while potentially maximizing returns. Ultimately, the key to successful investing is to have a long-term perspective, a solid investment strategy, and a willingness to adapt to changing market conditions. By following these principles, investors can potentially achieve their investment goals and build long-term wealth.